Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney says starting this year, GST payments will increase by 25% over the next 5 years. Ottawa will also provide a one-time special payment equivalent to 50% of the GST credit. Carney says the move is in an effort to tackle affordability concerns.
We're working to address the root causes of inflation and working on longer-term solutions to bring down the cost of groceries in Canada. That starts by improving the resilience of our supply chains. Because when issues arise in supply chains, from transportation to process to distribution, costs rise at every step along the way, and these costs end up on the grocery bills. These payments make up for the higher level of food prices since the pandemic.
Allied Gold shares are getting a boost today. They're up a little under 4%. That after China's Zijin Gold agreed to buy the Canadian miner in a deal valued at $5.5 billion, with shareholders receiving $44 per share in cash. The acquisition will add 3 African assets to Zijin's portfolio that are set up to produce up to 400,000 ounces of gold. We'll find out more when we speak with the CEO of Allied Gold coming up in about 10 minutes. China says a preliminary trade deal with Canada acknowledges a new type of strategic partnership and is not aimed at the United States. This comes after Washington threatened 100% tariffs on Canadian goods if the deal was finalized. The agreement would ease Chinese tariffs on Canadian canola and allow visa-free travel for Canadians. Ottawa is seeking to diversify trade amid an escalating U.S.-Canada trade war. And taking a quick peek at the markets, you can see the TSX well into record territory right now, both as an intraday high and closing high if it continues this way. It's up 0.28%. And south of the border, another good day down there as well, bouncing back after a week last week. You can see the S&P 500 off by 0.55, Dow up by 0.36, and the NASDAQ moving ahead almost by 0.6. We're waiting to hear from the U.S. Federal Reserve on whether or not it's going to cut interest rates. Let's get more on this and what this means for the U.S. economic growth in 2026. We're joined now by Clay Kahn, Managing Director at Neuberger Berman. Clay, thanks as always for joining us.
Thanks for having me.
All right, let's talk about that the Fed announcement this week. What do you think we're looking at?
So just taking a step back, if you look at where we are in the cycle, inflation continues to drop. Jobs are holding steady. And if you're looking at the Fed's mandate, which is a dual mandate of jobs and inflation, and they've cut a few times last year, we think for this upcoming meeting, we're looking at a pause. That being said, the policy rate at 3 3/4, just putting it all together, all the puzzle pieces together, there is room to drop another 3/4 of a point down to 3%, which we think will be stimulative to markets and the economy.
So you're thinking 3 more cuts and maybe 2 more cuts?
Yeah, 2 or 3 more cuts. Our fixed income team is poring over the data daily, meeting with our broader asset allocation team across public equities, fixed income, and private markets, and just putting it all together. There's the tailwind of economic strength, and there's also the tailwind of easing inflation. So green light, green light. The yellow light is really on the job side, where about 12 months ago, we were seeing new job creation in the 100,000 plus range, and now we're talking 5 digits. So a meaningful deceleration in job creation, but there's still growth there. So that gives the Fed enough ammunition to pause for this meeting, but for the upcoming meetings, 2 or 3 for 2026.
So what do you do with those kind of opposing situations there? Where are you looking? Which markets?
In a word, we like equities, and we definitely like global equities. You might remember last year when you were kind enough to have me on the show, we liked equities as well. We were also overweight international equities, so developed market ex-US. So think Europe, Japan, UK. And just putting that into context, 2025 was a banner year for equities across the board. with the S&P 500 up 18%, so a good year by any standard. But international equities, so the group that I named was up almost double that, 32%, and 34% for emerging market equities. So meaningful outperformance, almost a doubling of the return of the S&P 500 relative to, for emerging markets and international equities. So for international, we've reduced that weighting to market weighting, largely because the valuation has hit what we think is a fair relative value to the S&P 500. I can get into that. But we think EM is super attractive at 16 times forward earnings relative to the S&P 500, 26 times, and international at 18 times.
Okay, let's talk about the first part, the non-emerging markets, the overseas markets. You kind of scaled back a little. Elaborate on that a little more. Expand a little more on that.
So there's a lot to unpack there, but if you look at the S&P 500, just a simple way of looking at it is 26 times. As you know, and your viewers know, the Mag 7 comprises a meaningful share of that, about 35%. So looking at the S&P, what we call 493, that's about 20 times earnings. And if you look at the international stocks, so EFI, the index, it's about 18 times earnings. So given the growth profile, where you tend to have higher growth and higher earnings growth in the US, we like the US and EFI about the same, so we're neutral on both. But the market's telling us and giving us some interesting information this year. I know we're only looking at 3 weeks, but value has meaningfully outperformed growth. If you look at the Russell 1000 value index, it's up about 4.5%, while growth is actually down. So 6%, 5 to 6% spread. And the Russell 2000 is also up pretty meaningfully, high single-digit returns. And those tend to be more tied to the economic cycle and growth. So the market, the information that it's giving us is that they believe in the reflation story as well. And a lot of these markets, the international markets, the EM markets tend to have more cyclically tied value-sensitive industries, which is part of the thesis. But the other part of the thesis, which we think is a big one, is the AI theme in the EM, which I'm happy to get into as well.
Yeah, well, let's talk about it. What do you like about AI when it comes to the EM?
So broad strokes, about 4 years ago, let's say 2022, spending by the Mag 7, and this excludes Oracle and others, but let's just talk about the hyperscalers for AI and just CapEx in general was about $400 billion. That's expected to double in 2026, in part because of the OBBBA bill, which provides some tax incentives to spend this year on CapEx. So a doubling. But just to put that into context, because those are both very large numbers, the market capitalization of the TSX 5 largest banks is about $650 billion. So very, very meaningful spending. And those headline numbers should work its way to the ones that provide picks and shovels, essentially, to the AI infrastructure and value chain. And a lot of those businesses are located in the EM. China, Korea, Taiwan. A lot of your viewers might not know this, but Korea was up 70%-ish last year and is on a tear again this year. Taiwan is up meaningfully. And a lot of those are the AI theme names. So think of AI, digital infrastructure, semis.
Okay, we're going to have to wrap it up there, Clay, but thank you very much for joining us.
Awesome. Thanks for having me.
Clay Kahn is Managing Director at Neuberger Berman. Coming up, Zijin Gold signed a deal to buy Allied Gold for $5.5 billion in cash. We'll get more on this from the CEO of Allied Gold. Well, as the price of gold continues to set record highs, we're starting to see some merger and acquisition activity in the sector. Toronto-based Allied Gold has signed a friendly deal to be acquired by Chinese miner Zijin Gold for $5.5 billion in cash. Let's get more from this from Peter Marrone, the chairman and CEO of the Allied Gold Corporation. Peter, thank you very much for joining us today.
Roger, I'm happy to be here. Thank you for inviting me.
Why sell now? Why not wait? I mean, gold looks like it is going to continue on its run. Would it not be worth waiting for you? See what other offers might come up?
As we said this morning in our announcement, this is part of a broader process. We looked at the landscape from the point of view of what assets are there to purchase that would be synergistic. What can we afford to pay given our balance sheet? What's in front of us in terms of the obligations vis-a-vis that balance sheet? Are there business combinations that we could pursue? In the end, we also looked at it from the point of view of if there's a buyer, who is a logical buyer or logical buyers, and what should they be paying? I don't believe that anyone would price something on the basis of the gold price today or on the basis of where the gold price should be expected to go. normally, as you're aware of the market, people are pricing things based on some discount to gold price. So if I look at it from that point of view, with a discount to gold price that is above where gold price is in analyst models and in market more generally, we're getting very fair value for our shares. And adding to that is we're at an all-time high. We are at the high for the year in the last 12 months, and we're being paid a premium on top of that high, and a premium that is close to 30% to the 30-day volume-weighted average price of the stock. I think the shareholders should be comforted that they're getting a very fair deal. And one more thing that I think is important here, which is that we're in a business of creating options and optionality. So in that context, and risk mitigation is part of that. In that context, I don't know where gold price will go. I'd love to believe what you've mentioned, that gold price continues to go higher, but equally it could go lower. And if it goes lower, shareholders have the certainty that they've got an underpinning in our share price with a cash deal of $44 per share.
Now, we've heard from some shareholders that feel that this could have been done differently, maybe re-rate on its own, and they're not excited with this deal. Are any worries about the vote that's coming up?
Well, every shareholder that is invested in our stock bought shares at a price that is lower than this, and every deal that we've done is at a deep discount to where this price is at. If I looked at it from the perspective of most of our larger shareholders, and certainly the shareholders that participated in the preceding financings that gave our balance sheet the robustness to build out our growth and get that re-rating, they would be making a multiple of their investment, certainly a premium to their investment, if not a multiple. So from that point of view, I'm not concerned about the carry on that vote at all. I would say to those investors that are saying, well, a re-rate is coming, so why not wait? I would say to them, why didn't you invest earlier? Don't wait for the re-rate, and you would have made a bundle of money in the deal that we're proposing.
Has anybody from outside the company looked at the deal and reviewed it?
Yeah, so we had a financial advisor. We formed a special committee. That's very typical, but I think it's important for governance. And that special committee had its own advisor that provided a fairness opinion, as we disclosed this morning. And so there is a fairness opinion, and fundamentally the value is there at this price. The company is fairly valued. Can we argue that there's a range? The answer is yes, but we're well within that range. And we also have to look at it from the point of view, as I said a few moments ago, Roger, of what's the gold price that you assume. And if we look at the analyst models, what's in market, how people are investing in our stocks, they're not taking into account $5,000 gold. They're not taking into account $4,000 gold long term. It's closer to $3,000. And I would argue that in what we're being offered in cash, all cash, is well above what is in those models and the use of gold price.
Now, this comes just after, not long after the announcement of deals and potential deals between China and Canada, but also we're in the middle of the trade war with the U.S. Any worries about the optics of this and then the fact that another company is coming off the TSX?
Well, let me deal with the first point first. I don't know that we've got the competency to deal with the geopolitical aspects. This is a company that has acquired assets before. It's a company that has acquired Canadian assets. Gold, as much as I admire the metal, is not considered a strategic metal. So I'm not concerned on the geopolitics. And on the TSX side, in the same way as when we sold Yamana in 2023, we formed Allied and listed it on the Toronto Stock Exchange. I will express a wish, which is that let's work on completing this deal. But once this deal is completed, are there other deals that can be done with this fit-for-purpose management that has done it with Yamana, has done it with Allied Gold, and are there other opportunities?
What's next then? What can you allude to what you might be looking at next?
At this point, I'm focused on going to our shareholders, communicating the message about what this deal is about and why our board saw fit to accept this deal and getting the deal completed. Let's come back to this in a few months and see if there's something else.
Okay, and if the deal by chance doesn't go through, what would be Plan B for you?
We continue with that robust growth that we have, as you described. What was it compelling to the multiple parties that looked at us and this winning bid? What was compelling to this bidder and others is that we are a mid-tier company that is underpinned by 2 tier 1 assets. They are paying a robust price to get that, a fair price, however, to get that. So in that context, my view is that we continue with business as usual, and we look to the other strategic opportunities to create value for shareholders that were always being contemplated and weighed one against the other by our board of directors.
Okay, we'll leave it there, Peter. Thank you very much for joining us.
Thank you for inviting me.
Peter Morona is chair and CEO of the Allied Gold Corporation. Coming up, a wild winter storm hitting parts of Ontario and Quebec on Sunday, with more than half of the flights at Toronto's Pearson International being canceled. We'll take a closer look right after the break. Well, yesterday's storm in central Canada, Ontario, Quebec left hundreds of people stranded, flights canceled, and today they are still trying to clean up from this storm. Roads are still a mess, and for more on it, we were joined earlier by CTV's Scott Hurst.
And now this storm also impacting the Maritimes, but not just that portion of Canada. This storm stretching all the way down the eastern seaboard of the U.S. and even impacting flights as far south as Texas, dealing with snow as well throughout the weekend. You mentioned the flights at Pearson. Of course, it'll be a multi-day cleanup at the airport, and a significant amount of flights canceled yesterday. As you're looking at video from yesterday of the cleanup, trying to get the runways clear for the planes to continue, and already today about a quarter of departing and arriving flights canceled for the day, and many others delayed, trying to deal with the snow. Is record setting at Pearson, in fact, in terms of a daily snowfall total, and already record setting for the month of January at Pearson Airport as well. In parts of Toronto, Andrew, some 40 to 60 centimeters fell, and in many questions, as people are trying to dig out their driveways, dig out their cars, the question now is, where does all that snow go, with snowbanks and snow piles, trying to shovel it off your driveway, getting higher than 6-7 feet in times, and making it very difficult to keep up with how much snow fell yesterday, in fact.
It is like the curse of Sisyphus, isn't it, in Greek mythology? You throw the snow onto the big bank, and then it comes sliding down again.
Yeah.
Anyway, the U.S. is also battling its own monster storm, and that has turned deadly. Tell us more about that.
Yeah, it has turned deadly, and now there are also states of emergency that have been declared in more than 24 states, and so far 11 deaths in the U.S. blamed on the weather, from winter storm to freezing rain, in impacting so many parts of the country and impacting so many people. More than 185 million people in the U.S. were under some sort of winter weather warning or alert this weekend, and to single out yesterday, there were more than 12,000 flight cancellations across the U.S., Andrew, with now making Sunday the worst day for flight cancellations in the U.S. since the pandemic. So that really puts it into perspective with how widespread the impact from the storm really was across the U.S. and Canada.
And that was CTV's Scott Hurst talking to Andy Bell. Now, Canada's Arctic makes up 40% of its total land mass, but just 0.5% of its GDP. It's filled with minerals, but the production of them is lagging compared to our adversaries who are interested in this part of the world. CTV's Heather Wright has more.
Come on. Come on, guys.
There are few things more quintessentially Arctic than being pulled by a sled dog across a frozen lake.
In the wintertime, we offer kick sled tours pulled by huskies. Good boy, bud. Good boy.
Richard McIntosh is the co-owner of Sundog Adventures and says tourism in the north continues to grow.
Rum, come on, Rum.
Attracting not only visitors, but also employing thousands of people.
We hire guides every year, and we hire service staff every year. But without the tourism, we wouldn't be able to employ nearly as many people.
Canada's Arctic makes up 40% of its total landmass, but just 0.5% of its GDP, according to government figures. Mining continues to be the main industry in the Arctic, but insiders say the full potential of resources here remains untapped.
There's 2 gold mines in proximity.
Karen Costello is the executive director of the Chamber of Mines and says more government investment is needed in the north, not only to attract private investment, but to beef up security as well.
You can't get more present than that. When mining is here, mining employs Northerners. It works with Indigenous businesses, Indigenous development corps.
Canada's Arctic economy is quickly changing. Warming seas and increasing global demand for critical minerals and natural gas have intensified competition in this region.
Everybody is in this infrastructure race.
Brendan Bell is the CEO of West Kitikmeot Resources, an Inuit-owned company spearheading the development of a deep water port and extensive road network known as the Economic and Security Corridor. It's a massive project with a number of environmental concerns, but if completed, it would connect Nunavut with Canada's highway system in the Northwest Territories.
Canada has lagged significantly behind both our adversaries and our allies who are interested in this part of the world. So I think we're left with very, very few options here, but to make some significant investments.
Well, Canada has some of the largest reserves of critical minerals, which are used in everything from smartphones to cars. It lags significantly behind countries like China in the ability to process them. It's another area experts say is in need of investment.
And that was CTV's Heather Wright. Up next, some Canadians will get tax credit top-ups to tackle grocery costs. We'll get more on this after the break. Allied Gold shares are getting a boost today. They're up about 3.8 right now after China's Xijin Gold agreed to buy the Canadian miner in a deal valued at $5.5 billion. Shareholders getting $44 per share in cash. The acquisition will add 3 African assets to Xijin's portfolio that were set to produce up to 400,000 ounces of gold, and comes as bullion prices surge past $5,000 mark, $5,100 US. CoreWeave seeing a surge today, nearly 10%, 9.5% roughly. The chip giant NVIDIA is investing an additional $2 billion US into the company to help speed up an effort to add more than 5 gigawatts of AI computing capacity by 2030. Under the collaboration, CoreWeave will be among the first to deploy new NVIDIA products, including storage systems and a new CPU. OPEC Plus is likely to maintain its oil production pause for March, according to Bloomberg. The oil cartel will review its decision to freeze output levels during the first quarter, but is expected to leave the policy unchanged. OPEC has been dealing with a global surplus and a wave of geopolitical risks. The report says a significant supply disruption from events in Venezuela and Iran could prompt the organization to bolster output. And looking at the markets, another good day for the TSX, a good month, really. It's up for the year so far. And today it's up about 0.29% and into record territory south of the border. Green day down there as well. No real complaints anywhere you look. You can see the S&P 500 up by 0.57, Dow by 0.34, NASDAQ by 0.65. There has been a bit of a struggle to start the year, though, south of the border. With Parliament resuming after the winter break, Prime Minister Mark Carney unveiled a boost to the tax credit as part of a suite of new affordability measures. Let's get more on this from Dana McCauley, CEO of the Canadian Food Innovation Network. Dana, thank you very much for joining us.
It's an absolute pleasure.
All right, let's talk a little bit about what this break is or what the changes are.
Yeah, it's so nice to wake up to some good news for a change. So the Prime Minister announced sort of a two-sided strategy, one to help consumers and the other to give industry some time to catch up and make some long-term changes. So on the consumer side, we've got 25% bigger GST credits coming to the Canadians who need them most, plus a 50% bonus this year, which I believe is being called a grocery relief type of bonus. I'm not sure I've got the terminology correct. Mm-hmm. And then $500 million from the Strategic Response Fund to help industry to figure out supply chains and try to keep food prices from going up and hopefully even in some cases help them to go down.
And have they gone up that much? Is it that noticeable?
They have. It isn't necessarily even across all kinds of food, but definitely inflation on food has outpaced inflation in other parts of the economy pretty much for the last 5 years plus. So it is an issue. And, just anecdotally in the grocery store, I see people making, like decisions in the meat aisle in particular and having conversations with their family. So I think everyone's feeling it regardless of their income level.
So was this increase overdue, and will it help?
I think this will help a lot. Since the pandemic, everyone in the food business has basically gone from crisis to crisis to crisis. So Canada's food supply chain is made up mostly of medium-sized businesses and small businesses. And those folks have really been spending all of their time just trying to deal with the news cycle and game plan around either, COVID issues or supply chain issues that have been affected by tariffs and other geopolitical types of news. Even the war in Ukraine, had an impact on anybody who was using seed oils, for instance, like canola and sunflower. So it's just been pretty much kind of nonstop, and we do need to help the folks who are struggling to feed their families and get all the right nutrients onto the table. And then we also have to inject some focus. I love the fact that there's a focus on supply chains and some money to help people work towards that focus. So often we're trying to solve a whole bunch of problems, and it's hard to know, it's a bit like whack-a-mole, which problem do I deal with today? So choosing supply chains is extremely astute, and I think will help to move the needle.
I was going to ask, any concerns that money just kind of might get absorbed by businesses and disappear without changes being made?
Well, no, I don't think so. I think that everyone wants to improve their supply chains. I think, the business people that I speak to, I have 8,000 members who are working in the food sector in Canada. They are all, ambitious and trying to grow their businesses and in turn grow the economy. Where we could have some issues, though, is a lot of the supply chain problems that we face are rooted in interprovincial issues. So getting the provinces to sit down and just, say, yes, this makes sense for all of us. My big worry is that one province will say, well, the way we handle, axle weights on trucks is the way the whole country should do it, et cetera. And so there's some negotiation that has to happen as well. It's not all in the hands of business.
That seems to be the general consensus about eliminating the interprovincial trade barriers. One thinks theirs is better than the other, and things get stalled. Is there anything else you would have liked to have seen mentioned today, announced today?
It's pretty new news. I'm here in Burnaby this morning, so it all landed a little bit early. From what I've read, I think this is an excellent start. I think the Strategic Response Fund is a good fund to be, working on this issue. And I feel quite hopeful, to be honest. It's one of the first times in weeks that I've woken up in the morning and the news that's hit me has actually been good news. So I just want to focus on using all of these new tools effectively and getting everybody, focused and working in the same direction.
Okay, Dana, thank you very much for joining us today. We appreciate it.
Absolute pleasure. Dana
McCauley is CEO of the Canadian Food Innovation Network. Coming up, U.S. President Donald Trump is threatening 100% tariffs on Canadian goods. The U.S. president isn't bluffing. The repercussions could be staggering. We'll break it down for you after the break. U.S. President Donald Trump is once again trying to rattle markets. They're really not being rattled today, at least this time with a threat to impose 100% tariffs on Canadian goods if Ottawa makes a deal with China. Joining us now to walk us through this latest development in the trade war is Jeff Mahan, former Deputy Director at Global Affairs Canada's China Division. Jeff, thanks very much for joining us today.
Happy to be here.
Is this another taco?
Well, I think it's a little more complicated than that. I don't think this 100% tariff threat is going to come to pass, just given the sheer magnitude and havoc that it would wreak on the American economy. But it does send a signal that the United States is quite upset and that it is looking for Canada to play ball with it.
And is it realistic what he wants? He doesn't want any kind of a deal with China for Canada. Is that realistic? Is that possible?
Well, let's make sure we get our terminology straight here. What do we mean by a deal? So what the Prime Minister has put forward is a strategic approach with China. It's not an actual trade deal. And the CUSMA Article 3210 that restricts our ability to be able to enter into free trade agreements with non-market economies is subject to a particular type of agreement. The FTA that would be registered, for example, through the WTO. The type of deal, or more the strategic approach that the Prime Minister was able to reach with China was about resolving our current trade dispute. And indeed, I actually think that this would go a long way in setting a precedent for the Americans to solve some of their concerns that they have with China, concerns that Canada shares.
Does it feel that this deal, or no, sorry, the agreement they have, it's so easy to say deal, I apologize, with China, is this a bit of a jab at the U.S., maybe to get them to sit up and take notice that Canada needs to be taken seriously when it comes to CUSMA?
If it is, I would say it's an auxiliary approach. I think the real thing that we needed to do is find a new modus vivendi with China. China has a very unique economy that is different than ours. So it creates a lot of frictions when we trade with it under the current rules. So we need to find a new way to engage. And that's exactly what the strategic approach does. It shifts the focus away from trade towards investment. And that gets at the overcapacity concerns and also the threat that a cheap deluge of Chinese imports would do to undermine the fundamentals to lift Canada's nascent EV sector off the ground. So I actually applaud the strategic approach because I do believe the government has set a novel precedent for dealing with China in the 21st century. And I think other countries will take note of how this works, including the United States, and it might actually move us into a better relationship with China. So no, I don't think it's a jab, but it should also have the president wake up and see that Canada is doing things in the Americans' interests, although it might not necessarily look at that way on first blush.
And just going back, how do you feel it eases the concerns about overcapacity and similar issues?
Well, overcapacity is a concern because of the impact it has on prices. So if we put a restriction on the amount of goods coming in, final products, electric vehicles, then that's going to manage the supply and demand dynamics here in the Canadian market. So those overcapacity, which essentially would be a deluge of supply that pushes down prices, that undermines those signals for investors to be able to make long-term decisions to build up our own sector are going to be distorted. So it's going to now mean that Canada can actually have a chance of continuing to build that out. And I think this fits with the broader notion of a more strengthened continental supply chain, which is ultimately what Donald Trump's looking to do. Yes, he wants to reshore vehicle manufacturing to the United States. Canada's showing it's looking to open up a third way to be able to keep the North American automotive market sound by managing these overcapacity concerns.
And do you think Canada can negotiate on a level playing field, any kind of deals or possibilities with China? Is that realistic, or are we negotiating from a weaker position?
Well, I would frame it a bit differently. The way I see this is, what is Canada's strengths in its negotiations with China? It is that Canada is a G7 country. We're a liberal market democracy. We have the same type of economy that many of our partners have. And so therefore, we're sharing the same types of concerns that they have with China. And we're also tied at the hip to the United States. So if we're able to find a way to work with China to manage those concerns, to be able to both trade and invest in a more amicable manner, then I would actually see the Chinese would view that as a win. And that that is the leverage Canada has, is actually what many people see as our weakness, being so close to the US. But this is what makes it such a delicate balance for Canada and the Prime Minister to engage with China, to manage those concerns, via his variable geometry, but in a way that also doesn't poke the American bear.
And any concerns that we're dealing with China right now, when they appear to be having a little bit of upheaval? There's been a bit of a purge in the military by Xi. Any concerns about that spilling out further?
Oh, there's always internal political intrigue in China. That's what's going to happen when you have a non-democratic political process. So this is part and parcel of Chinese system. I think getting into the details of that would be beyond the scope of discussion, but I don't think this is the kind of thing that we need to be worrying about right now as we trek through the immediate challenges ahead of us.
So in the end, it all kind of comes back to Canada and the U.S., though, with CUSMA and figuring that out.
Absolutely. Our relationship with China is framed by our relationship with the United States. Unfortunately, we've got a difficult relationship with the United States right now, but they're not going anywhere, and nor is Canada. So we're going to need to find a way to deal with each other in terms that can that work for both. Canada does need to diversify its economy. That doesn't mean substituting out the United States. It means shifting the proportion of our exports, and ideally through growing our overall exports, which would in turn mean growing our economy. So that I think is what the government's focus is, not bumping away America from us.
Okay, we'll wrap it up there. But Jeff, thank you very much for joining us. Appreciate it.
It's my pleasure. Thanks for having me.
Jeff Mahan is Director of Geopolitical and International Business. And we'll have more coming up after the break. For the last 2 years, more breweries have closed than opened, and the pandemic, tariffs, and inflation have reduced the sale of Canadian beers. Consumers are going out less often to try and save some money. CTV's Alison Bamford has more.
Taps are flowing at Regina's Rebellion Brewing, despite turbulent times over the last 5 years.
We've worked really hard, really diligently to get our business in order, to get our sales in order.
The pandemic, inflation, and changing consumer behavior set back Canada's craft beer industry. A report from Restaurants Canada shows 41% of Canadians reduced their alcohol consumption over the last year, citing health concerns, lifestyle changes, and money as the main drivers.
Consumers are going out less frequently, so you're seeing less beer sales in restaurants and bars and things like that, and craft breweries as well.
Canadian beer sales dropped 20% from 2019 to 2025.
It used to be you could just open your doors and sell a bunch of beer. That's just not the case anymore.
For the last 2 years, more Canadian breweries have closed than opened, a trend not seen in 15 years, according to beer educator Jason Foster. His stats show the total number of breweries dropped 2.9% in 2025, a gradual reduction he expects will continue for the next couple years.
The breweries that'll be left at the end of it, I think, will be stronger and the better for it.
Brewers say fluctuation is normal in any industry, and the taps aren't drying up. The latest numbers show craft beer sales are up year over year in Saskatchewan and Alberta. At Rebellion, sales have jumped for the last 6 months, and the Regina-based brewery is opening a new tap room in Saskatoon.
We're feeling really confident going into 2026.
And that's something he'll drink to. Alison Bamford, CTV News, Saskatoon.
Well, gold is fueling the precious metals rally as it surges past 5,100 even, a historic high that's being fueled by a crisis of confidence in the Trump administration as it rattles global markets. For more on this and Allied Gold's deal with China's Xi, we were joined earlier by Jamie Murray, president of the Murray Wealth Group.
Prices breaking through 5,000. There were some thoughts that might be a little bit of a temporary short-term ceiling, but what we're seeing overnight in the pre-market is that it's just going to blow through this level. Silver as well, up very strong this morning, so it's just highlighting that demand for precious metals.
What makes you think it might be a short-term ceiling?
I mean, that's just in terms of technical analysis. A lot of these big round numbers. There's a few prognosticators 6-9 months ago saying that 5,000 might be a good target for the end of the year, and we hit that. And there's certainly some of the early money is going to look to exit at some of these prices, and so that was just the scuttlebutt in the market. But obviously that's not what we're seeing yet, and then more deals like what we're seeing for Allied, I think, is going to actually increase demand at least for the miners. And what the political news out this weekend certainly isn't calming anyone's nerves. So I think we could see further strength through the week.
Let's get your thoughts on that deal for Allied. Is it good? I mean, it's going to play out politically as well, of course, south of the border.
Yeah, so I mean, Allied's properties are all in Africa and in some jurisdictions that are not exactly the most mining friendly. And so I think this is just a management team. I mean, this is a former management team that ran Yamana Gold for many years. Just looking at the market and the tea leaves and saying, I'm sure it just IPO'd a couple of years ago, but I'm sure the team that put it together is doing quite well for themselves with this deal. And I think this is just them maybe looking for a good time to exit and maybe even looking for potentially, and this is my own speculation, another opportunity to continue to ride this gold wave by starting another venture.
And so we're going to speculate for a second. Where any ideas where we might see that?
No, I have no clue on where that could be, but I'm just speculating. I mean, certainly we haven't seen a ton of gold takeouts, particularly this one. It's clear that the management team, by selling to a Hong Kong, China entity, is most likely looking to move on and secure those nice compensation packages. So I just think, given what we're seeing in the market, it still seems like this is going to be a gold leg that has a multi-year move, and so I think there's still some room to run for other stocks.
And a 27% premium over Allied's 30-day average. What are your thoughts on that?
Yeah, I mean, that's pretty much in line with I think a lot of these friendly transactions that happen. Certainly, there's a little bit of discounting of this deal only being a small premium over where the stock was trading last week. And so obviously this deal was worked on and seeing the gold price accelerate, they probably didn't think it was worthwhile going back to negotiate. But I mean, it comes back down to typically when we see these types of deals with small premiums over the last couple of trading days, it just is a signal that the management team is, thinking this is a good time to exit the name.
Do you think this will kind of trigger more sales like this?
Will it trigger more sales? I certainly think there's some of those early investors in gold and some higher risk companies that are probably looking to cash in on the move that we've seen over the last 2 years, and particularly over the last 9 months. So I certainly wouldn't rule it out. As well, the seniors and intermediates are going to be flush with cash, and so they're going to be looking at some of those juniors. And that kind of ties back into how we're playing the gold sector. We own Major Drilling, which is the largest mining driller. And so all these juniors and being flushed with cash from recent financings, wanting to prove up the reserves, are going to likely be a very active drilling season in 2026. And so that's what we're really excited for.
And so anywhere else are you looking within gold and silver?
Yeah, one of our other major holdings is Hudbay. We really like that. Again, the takeout today was a company with African mines, a little bit higher up the risk spectrum politically, and not really where we would play. But like Hudbay is in very stable jurisdictions. They have obviously operations in Canada, some down in South America, and then a big development project down in the U.S. So we really like where it is from a geographical perspective, and then they have obviously the exposure to gold, but also as well a variety of other base metals. So it's really a nice diversified play on the whole metals and materials move we've seen.
All right, that was Jamie Murray, president of the Murray Wealth Group. Market calls coming up next. Today on the show, we have Mike Finneker. He is the portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. He will be taking your questions on North American large caps. All right, let's take a look at how the markets are performing right now. Bay Street is the one to watch. It is in record high territory as we take a look at it. You can see it's well above, closing in on 33,300. In fact, it's up by 0.4% into record territory. And some of the movers we want to talk about, Allied, of course, is one of the big ones. All the gold companies doing well today, but Allied announcing it is being bought by Zijin a subsidiary of Zijin, a Chinese group, which is going to buy Allied Gold for about 5.5 billion Canadian. The mines in Africa, 3 mines there that they will be taking over. So you can see that it was up today. And also some of the other leaders right now, you can take a look. Aya Gold, it is up 7.88%. And that is based on, we also saw some changes in their ratings. The silver price target, or Aya Gold and silver, their price target raised to 29 from 19 at Scotiabank, and keeps it as an outperform. Eldorado Gold, similar situation. Let me track that down for you. Eldorado, Scotiabank also raising the price target from 33 to 59 for it. It's up by 8.88%. That is good luck if you're Chinese. And Centerra Gold is the other one. It's up by 6.25. Similar situation. It also saw its performance raised. Scotiabank raising it from 219 from 13.50 and keeping the outperform. A couple of others worth taking a look at. Bombardier off by about 6.56%. It's up and down. It's been on quite a roller coaster ride as people try to figure out what to do with that one. Quick peek south of the border before we go as well to see how they're doing. And you can see everybody in the green south of the border. S&P 500 up by 0.6 nearly. Dow by 0.3. And the NASDAQ up by almost 0.7. That is it. Thanks for watching Morning Markets. We'll see you back here tomorrow.